Hey everyone, this is Justin Amos, and today I would like to talk to you about the basics of options trading. Now, for the sake of this video, I'm going to start and assume you know nothing about options and nothing about stocks. So as far as a stock goes, most people would understand you buy low and sell high, and that's certainly a strategy, something that people will use in the stock market. Many people use that strategy. They invest for the long term and the stock price increases over time. So let's just throw an example in here to understand that real quickly. That let's say you buy a stock of Walmart. It's about $135 currently. And let's say I hope to hold that for 5 or 10 years and it continues to go up and it's doing really well. So let's say it goes up to about $200. Well, I bought it at 135 and it's at 200. I still own the same share, but now I can sell it for more than I paid for it. So I can sell that for a capital gain. And along the way, because I'm holding a stock, this particular company pays a dividend every quarter. So every 3 months, I get a dividend on top of the price of the stock increasing. So that's one way to make money in the stock market, and it's ways many people do it. They buy, they hold long term. It may be through 401ks or IRAs or just straight out buying stocks, but many people do that. But for the scope of today's video, I just want to talk about options. Some people know generally what they are, some people's never heard of it, but we're going to start from scratch. So in the stocks, you hope to buy low and sell high. That's certainly a strategy. But with options, I can buy low and sell high. I can buy high and sell low. I can sell to open and buy to close. There's so many different strategies with options, and I'll make more videos as we go. But for today's video, we're just going to do the basics. So if I'm expecting that stock to increase, uh, probably over a relatively short period of time, I'm going to buy a call option. And it's important to get these correct. So if you're wanting it to go up in value, if you're expecting the price to go up, you're speculating, you're going to buy a call option. If you're expecting it to go down, you'll buy a put option. So let me explain how this works. Let's say the price here is at 130, and I think, well, it's going to go up to 140 in the next month or so. So maybe I buy a 3 months expiration because options, unlike stocks, have an expiration date. You are buying the right to, in this case, purchase at or below a certain price before a specific time. So, with this being said, I'm buying the right to purchase a stock at $140 a share, even though right now it's 130. So I'm getting it cheaper. That's how it's going to work out. I'm getting it cheaper than if I were to just straight out buy them. So if the price goes to 140, then I'm moving in the right direction. Let's say it goes up to 145. Well, now I have the right to buy it at $140, even though the current price is 145. So I could buy it 140, sell it to 145, but typically I'm going to do a different strategy and never convert that to stock, but I'll show that later in a video. The point is that you're purchasing the right, but not the obligation to purchase this stock at a certain price at or before a certain time. So that time is set up beforehand with you. You pick that time. And if it goes in your favor, you make money and you actually make accelerated earnings more than you would through a stock. So hopefully that makes sense with the calls. Now the puts are a little bit different because I'm wanting to sell at a certain price. Let's say you're at $130 and I'm wanting to have the right to sell it at 120. Well, it wouldn't make sense now, but let's just say the stock market's going down. Well, now this is 120 mark. So it's went from 130 to 120, and then it keeps on going down to 117 or something. Well, now the stock is at 117, but I purchased the right to sell it at $120. So now it's lower than what I purchased the right to sell it for. I can sell it higher than the current price. And that's what we're going to use for a put strategy. And this is, both of these strategies are buying to open. So we're going to buy a call, or we're going to buy a put. Now there's other ways you can do it. You can sell a call to open it. You can sell a put to open it, and then you buy it back later if you choose to do so. Now, again, the difference here, you buy a stock and you hold that stock until you decide to sell it or the company goes out of business. And you're just going to hold it for that period of time. You hope that it goes up in value and you're collecting dividends along the way if that company offers dividends, which that has its place as well in investing. There are also good ways to do that, but for today we're talking about options, and we're just going to compare the basics here. So you've got that for stocks, and your option strategy is buying low and selling high, and along the way you're estimating that it's going to go up over a certain period of time. So it's kind of like a coupon. You have a certain period of time before it expires, and you need it to move in your favor enough to make a difference before that time period. You sell out and you make money. Same thing with puts, only in the opposite direction. It goes down, you make the money. Of course, there's other strategies, but it's going to be the basics for this video, is understanding what a call and a put is, and that options have expirations as opposed to how stocks work. So hopefully that was a helpful introduction to that, and I'll see you in the next video. Stay tuned.